hello to everyone out there. We're going to begin the webinar in just a few minutes here, giving a few seconds to let anybody else join. Hello and welcome to the CattleFax Trends Plus Cow-Calf webinar. We thank you all for joining us here this evening. We certainly recognize how busy everyone is, so we appreciate you taking your time to be with us here tonight. I think we have a really good presentation built out that I think you'll all find pretty useful. So we want to thank Elanco to begin with for their sponsorship of this webinar and allowing us to make this webinar free for all cow-calf producers. So a brief outline for our presentation. We're going to start off with the market outlook and projections for the cattle and feedstuffs, and then take a closer look at the summer and fall calf markets and our expectations going into the second half of the year. Then we'll have a review of our recent cow-calf survey, and then Dr. Mark Armfeldt with Elanco will be speaking on disease prevention and vaccination programs. I'm Patrick Linnell, and I'll be taking you through the first portion of this discussion here tonight. So just starting off looking at the drought, with the El Nino weather pattern that we had here this winter, the wet winter and wet spring, looking throughout the country, we're at a dramatically different place than we were this time last year, and conditions are really pretty favorable all throughout the country, in most portions of the country. Comparing back to last year, the upper left-hand chart with all the orange, red, dark red drought areas, and you see virtually none of that here this year. So that'll certainly be favorable for summer grazing for folks throughout the country as we go into summer, as well as should set us up for, if the El Nino pattern continues, favorable winter forage, winter grazing prospects going into late fall, winter, and rolling into 2020. So in our last webinar in January, we talked quite a bit about the weather market that we were seeing and how that was impacting the fed cattle market. And so what this chart shows is the decline in carcass weights from October 1 going forward. And so you can see a sharp difference between what we'll call weather market years, where it significantly impacted the market, versus your average or normal years there in the blue. And so what we really had in 2019 was definitely an in-betweener, where we did see a larger weather impact, and we did see pounds of beef taken off the market, and saw a positive impact to the fed cattle market in terms of price, where we think we added about $5 to our spring high compared to where we otherwise would have been. Now, just looking at steer and heifer slaughter, up on the upper left-hand chart here, we've seen it running, slightly above or somewhat above year-ago levels here to start the year. Just with the larger on-feed population and the expansion here in the cow, or that we've seen in the cow herd and calf crops the last several years. Looking forward, we do expect that it should run about steady to slightly larger than year-ago levels through the summer. Especially as we come into this, our largest slaughter season of the year in May and July and June that we're in here now, or as we get into June. And the other important thing to note would be the red line at 480,000 head per week, which is essentially what we see as the 40-hour-a-week kill capacity with the packing capacity that we have out there today. So similar to last year, as we exceed that red line, we're going to continue to have to incentivize the packing industry, and with margin in order to operate, run over full capacity and running on Saturdays and things like that. Now shifting to the lower right-hand graph, looking at the non-fed, the cow and bull slaughter. We've seen a bigger year-over-year increase here in the first quarter, mostly driven by the dairy side, with poor milk prices for most of 2018 and to start off 2019. Seeing some induced culling on that side. And going forward, we do expect it to continue to run above year-ago levels on the non-fed side. And just like the fed side, continue to exceed the 40-hour-a-week kill capacity, which will also be keeping a lid on values on the non-fed side as well. So taking a look at beef exports. So we really struggled with beef exports coming into the first quarter with exports below year-ago levels. As a result, we evaluated and we decreased our beef export forecast from up 5% for the year, and now we're calling beef exports steady. So in the coming months, we expect that exports should be steady to higher for the remainder of 2019. With the newly announced Japan agreement, continued trade progress and improved relations with Canada and Mexico, and hopefully the ratification of the USMCA, all being positives to beef exports. And the other factor, we see that the African swine fever situation in China should also be supportive to some degree. Now, we do recognize that that we are at a TTP disadvantage or in tariff disadvantage as we pulled out of that agreement. So that will continue to be a challenge, especially as we progress, into the next several years, assuming we don't get, some type of trade arrangement with those Asian Rim countries to decrease our disadvantage compared to Australia. And then also just the risk with the global economy that if we do see a significant slowdown, that would also be, be a negative factor to beef exports going forward. But at this point, the positives suggest to us that we should be steady to higher for the remainder of the year. So looking at the competing meat side, and this is pork production here on an annual basis, we continue to see record large production there, and a pork chart would show the same exact trend, record large production year after year. And this is just a factor of, here lately, these competing meats have either been, especially the large vertically integrated processors, have either been making money on the animals or on the meat side. And they're also looking at this African swine fever situation and banking on continued export growth to fuel profitability down the road. So we're on pace for pork production to be up 3% in 2019, and we expect to add another 3% on into 2020. So looking at the China situation, there's been estimates out there that the African swine fever that's spread throughout the country has resulted in losses from anywhere from 15 to 20% of their swine herd, up to 40 to 45%. But whichever number that you want to tie to and when you expect that to hit the market, if you look at the size of that protein gap that would create, just a 20% reduction would be about 24 billion pounds. Now, for perspective, that means that all the pork exported in the world from all countries, if it was diverted to China, would still not fill that protein void. So that's where we certainly see this being a situation of where a rising tide should lift all boats, in terms of global protein demand. But we do recognize that we expect the competing meats, pork and poultry, to be the biggest benefactors. As you look from a price comparison standpoint, that they're just such a price disadvantage, or a more favorable price level compared to beef, to satisfy that protein demand. Okay, switching to feedstuffs. So, with this wet winter weather, and then building on top of that the wet spring that we've had through the Corn Belt and all the flooding up through those regions, this is a pretty busy chart with all the lines. But if you turn your attention to the black line for 2019, this latest point here, in terms of U.S. U.S. corn planting progress, the slowest on record. And so with this, with the slow planting, we can also expect slower or poor yields. As we look to the 1995, this next slowest year in terms of planting progress, that's exactly what we saw. We saw below trend line yield there as well. So that's something that we can expect. And also, if you're a corn farmer, and you plan to plant the corn, for the most part, you're going to plant the corn at some point. But with this type of delay and the conditions the wet conditions up there, we do expect that we'll also lose some corn acres as well. So in terms of the market reaction, where we really saw corn futures, broke out of this trading range, it broke this resistance level at about here last week. And so as we try to identify the next levels for corn, kind of this 425 to 430 area would be the next level of resistance, and then after that 450 to 455, and then on up into the 515 area. And really, as we try to figure out to which level we expect corn to go with this decreased corn production that we'll expect for this next market year, the next few weeks will be really critical to understanding acreage, planting, yield, and our expectations on whether this is going to be something that's going to be impactful to the cattle market here going forward. So in terms of looking at the Fed steer price, as I mentioned earlier, we think that the weather market added about $5 to our spring high that we made, just shy of $1.29. And so as we look forward, as we try to, we really think that this expansion year type seasonal pattern will be most indicative of the seasonal price pattern to expect. We anticipate the annual average around this $1.15 area, and with the expansion seasonal, we do tend to see a larger than average break, and then we'll also see that the seasonal low will tend to come a little bit later. With our export forecast now steady, we see that this $1 to $1.05 area is kind of our expectation now for the low. So taking a look at the February live cattle is really where we can start to build our expectations in terms of the summer feeder cattle market. With the February live cattle here in this about $1.17 area, really the mid to upper teens is kind of what we can expect to be the predominant trading range here in the coming months. And then below us, we have some really strong support at this 10 to 12 area. And recognizing that if corn rallies, we see a surge to corn, we could see potential upside to the February live cattle, as cost of gains increases, and the market needs to incentivize cattle to be placed. So then, looking at the feeder fed spread, so taking the August feeder cattle minus the February live cattle, and looking at that premium, it's been at about the $25 to $35 range for most of the last 3 years. And where we're currently at the lower end of that range, we think that we should be fairly supported at that level. But the big question is again, if we see that corn surge, could that decrease the spread and decrease the feeder cattle values? So again, that'll just be important to monitor here in the short term in terms of our expectations there. So looking at the active feeder cattle contract, again, trading at the lower end of this 2-year range, and I think we should be pretty well supported at that level. Now, depending on where the February live cattle go and the feeder fed spread is, the August live cattle or feeder cattle could reach the upper 40s to the lower 150s. But as just cyclically speaking, as we look later into the fall and winter and into 2020, we do think that there's cyclical risk lower that we do break this trend line, and that we do break trend, and we could push them lower on into 2020. But for the time being, we think that should be supportive. So in terms of the supply out there, moving away from the technical side of the market, we saw that the April 1 feeder cattle supply outside of feed yards slightly above last year, about 1% bigger in terms of just the supply of yearling type cattle predominantly out there. So in terms of the cash feeder market, it has a really strong seasonality to rally higher into the summer. And at this point, we would target in kind of the mid to upper 140s for a target here. And then depending on if the February live cattle end up stronger or corn retreats and becomes not an issue, we could get it up into that lower 50s area for a high in the cash feeder market. And the other contradicting kind of factors is, again, these positive moisture conditions. The summer grazing operators, yearling operators, as long as the cattle aren't too big, they do have some ability to wait to market those cattle until they see a price that they like or accepting of. But at the same time, feed yards are also full, with the large on feed numbers. So that will be somewhat restrictive on the other side as well. And just a quick note on the basis, similar to last year, the weak basis pattern is what we're seeing, where the futures are holding a premium to cash. For hedgers out there, or those just watching the futures to get price expectations, expect that to continue. Whereas we go into summer, the cash does lag behind the futures until we get into that later summer time period and closer to contract expiration. In terms of the calf market, now pretty similar to feeders in that we've just been in an extremely tight trading range here for the last 2 years, with $20 per hundredweight from the high to the low for the most part. Now, as we try to build our expectations around what to expect for the fall calf market and for the spring calves, what this shows is the percent change from the first half high to the second half low, using U.S. average steer calf prices. So over time, we've seen that there's been about a 12% average decline. But considering that we're still in this expansion environment and having larger calf crops year after year, should suggest that we'll have a larger than average break. And then there's also a correlation between larger breaks to the fed cattle market and larger breaks to the calf market. So we kind of expect that this 15 to 18% range is probably a pretty reasonable estimate. You know, a lot of the other years that are beyond that, you know, can be explained by, you know, for instance, 95 was a high corn year. So recognizing that, you know, that could be a risk if, you know, something does happen with corn. But, you know, 2008 coming out or into the global financial crisis, coming off the cycle highs in 15, and the futures flush in 16. Yeah, since we don't expect those to be, you know, factors at this point, yeah, I think so that essentially puts us into the lower 50s to the upper 140s for a low into the fall. And then just looking at that on a seasonal basis, so we came into the year with an expectation for a 160 average for steer calf prices, with a range of 140 to 180. So, which for our spring rally, 180 is basically right where it hit, at 181 there in early April. So from there, we expect that this expansion year seasonal to this market will pretty well fit as well. And we think that we'll probably push to, you know, lower lows than what we found last year. You know, at this point, we should think, you know, a safe expectation would be that kind of in this $1.50 to $1.60 area, you know, until we get a little bit closer in confirmation on, you know, actually seeing a few calves trade. You know, and there should be, you know, some calves starting to trade on the video auctions in the early auctions here within a month. And then the obvious risks is if we do see a bigger break to fed cattle or see that full break to $1, you know, $1.45 or maybe even reaching that low of $1.40, you know, is the potential risk to the market. But you know, for the time being, I think this is kind of our range of expectations. You know, also recognizing that, you know, there's these regional price differences for your area, and then also the weights, value-added programs, and then also the fact that summer cattle tend to sell for a bit of a premium to those sold during the fall run. A couple other notes, you know, we've seen some really large placements here the last several months. And as a result, the cattle on feed again are record large. So just something to monitor there. Profitability in terms of the fed cattle, they've been running at about a break even to a slight positive here so far in 2019, after being in a small negative there last year. And so, you know, that's something that we'll also be monitoring, because we're where we see that, you know, the fed cattle profitability really impacts the pass-through value and the feed yard demand for feeder cattle and calves. So our last webinar, we spoke pretty in-depth about the cow market, and we've seen where we've pretty much trended below year-ago levels for cow prices. You know, where we've really been struggled with large supplies of cows. You know, the dairy cow slaughter rates, as well as, you know, those packing capacity limitations. So as we look forward into the fall run, the last several years we've seen, you know, where we've made lower lows in the fall. So, you know, 18 was lower than 17. We expect that 19, our lows will be again lower than 18. You know, and I think that there's definitely risk below that 50-cent mark down to $1.45 or potentially down to $1.42 or to the low 40s, just depending on when the timing of the cows hits the market. So just to summarize a few of the items for the watch list. African swine fever will continue to be an issue and a wild card for the next several years. With that kind of decline in hog numbers, it's not something that's going to go away, and we'll need to continue to see how that plays out. Corn could be a risk to feeder cattle and calf values for the first time in several years. Record beef, pork, poultry production will continue to make exports, market access, and trade agreements all the more critical to keep our own protein supplies here on the domestic market at manageable levels. So, and then with these factors, we can expect that market volatility will remain elevated, especially on the futures complex side. And just recognizing that, with the risk of an economic slowdown, we've seen really good beef demand here in the last several years, and an economic slowdown would negatively impact that and the dollars coming into our industry as a whole. But for the time being, we do expect the industry will remain generally profitable, but recognizing that at this point in the cattle cycle, there is price risk lower into the early 2020s. So with that, I will pass it over to Tanner to discuss the cow-calf survey.
All right. Thank you, Patrick, and thank you everyone for joining us this evening. Like he mentioned, my name's Tanner Ahearn. I cover the calf and feeder cattle markets in the Southeast region, as well as some of our feed yards in Nebraska. So as we jump into things, each year CattleFax conducts a cow-calf survey. I'm going to start off by thanking everyone that participated in the survey this past year. We think that garners a lot of value for the producers who participated, as well as giving us a better idea of industry trends and such. Those who do complete the survey receive a detailed summary packet that can be used as a benchmark against their own operation. So if you're interested in this in the future, be on the lookout for this next January when we release the survey. So moving on to this year's results, it's actually looking back at 2018. We had almost 1,500 people complete the survey, and we estimate that it covered about 500 to 700,000 cows. Now, looking at the cash cow cost first, there is basically no change from 2017 into 2018. It actually only increased $1 as 2017 was averaged $603. You will notice that the calf revenue and the average price for the calves was down slightly. But when you analyze the CattleFax calf prices over the last couple of years, 2018 actually averaged above 2017. But during the last 2 to 2.5 months of the year, the 2018 prices moved below 2017. And so this just confirms how critical it is, how critical the timing is, and that you pay attention to the seasonality of the calf market, and especially as we all know, we get to the fall lows. And then as we look at the weaning weights, you'll notice that the steer and heifer weights were down 7 pounds compared to 2017. Last year, there's a severe drought in the western third of the U.S. I think you could probably see that a little bit in the drought monitor that Patrick showed earlier. And that, especially if you look at the southwest corner, they had some pretty dry conditions, and that drought crept into the southern plains into Texas and up to parts of Kansas, likely causing earlier weaning and then resulting in the weights being down. And then here, this is just our last point, 86% plan to expand or keep their cow herd steady in 2019, and 92% plan to do the same thing and 2020. This chart here just breaks down the regional costs by the different regions. I just want to point out a couple different things. You'll notice that the northern plains are consistently greater than any other region throughout the last few years. It's likely due to higher land values or pasture values compared to other parts of the country. You'll notice there's a increase over last year as well. This is likely due to the tougher winter last spring, but obviously probably not to the degree that they experienced this spring. So likely ate into the feed bill. And then, like I mentioned before, the drought in the west caused your feed expenses to rise. You'll notice that there wasn't a whole lot of changes here in the southern plains and the southeast. This chart here, the top one looks at the profitability based strictly on cash costs. You know, you'll notice there isn't much difference from 2017 to 2018. You know, and you'll notice that we put in our forecast for 2019. And I think the more important thing here is not to look at the absolute value, but look at the trend. As Patrick mentioned, prices will probably see some pressure and be lower than 2018. And then with the potential corn increase, we could see input costs increase as well. This bottom chart here, I think, is kind of interesting to look at and very thought-provoking. It's looking at your break-even, and then we made an assumption on return to management and depreciation. And we realize that the cash costs can vary greatly across regions, like I just showed, and you know, your return to management and depreciation can vary from operation to operation. But if you look at your average producers, you know, their break even is basically 130. Patrick mentioned earlier that steer prices have risk back to the upper 140s this fall. So that would say the steers in your calf crop will make you money. But if you consider that your heifers are discounted $18 to $28, that puts you right back or even below the break-even threshold. So, I mean, I think it's just important that you understand what your break-even is. For example, if someone were to come to your operation and want to forward contract your calves for fall delivery, do you have any idea what those cattle are worth? And more importantly, do you even know if you're being profitable? This slide here describes how those high return producers become the most profitable. There's 4 things that they do not compromise, and that's animal health, nutrition, genetics, and marketing. And 3 of these main points here, they have the biggest influence, or they have a big influence on the single most important economic trait, and that's fertility. Because last time I checked, you know, it's pretty hard to sell a live calf if you can't ever get the cow bred. But as we go through the rest of the results, I want you to keep these 4 bullet points in mind and see how they line up with everything. This is an illustration of the calf crop percent, or calves weaned per cow exposed, and it's broken down by the high, average, and low return producers. You'll see the high return producers have had a greater than 90% calf crop over the last 3 years. They're simply just more efficient, and that results in them having a greater return on their investment. And as you might expect, the low return producers have been 3 to 4 percentage points below that. You'll notice that the U.S. average is down almost 1% from 2017 into 2018. And if you think back into history, into 2017, during the breeding season there in the southeast, they were going through some drought conditions. You know, could have affected the breed back, and we actually received a pretty large sample from that region, so it could have influenced the U.S. average. Also parts of Montana and Dakota, and the Dakotas were experiencing this similar conditions. And then, like I mentioned earlier, the Northern Plains had less than ideal calving conditions last spring. One way for the high return producers that they might achieve a greater calf crop percent is with a tighter calving interval. The bulk of these producers, they have a less than 60-day window, and almost half of them are less than 45 days. And it makes sense, and it correlates to the previous slide that I showed, as it gives cows more time to get back to that optimal body condition score, and allows them to breed back faster as well. And then when it comes to marketing your calves, it allows you to have a more uniform calf crop, and you won't have those lighter weight calves that are bringing down your total average weight. This is just something to consider this breeding season. I mean, I realize this process takes time, and but if you want to capitalize on this, you need to start to have a plan sooner rather than later. This data here basically just supports what I mentioned, the tighter calving interval. As you see here, you get more pounds weaned and everything, more to sell. And you can see from here to here, we had a 9-pound drop, and then you can see as much as a 24-pound drop. And then overall, you end up dropping 45 pounds from a 45-day calving interval to 90 plus. Here's another way to look at it. It's the weaning weight sorted by return. And to no surprise, you'll see that the high return producers wean off a heavier calf. And, it's at least 25 pounds compared to your average, whether you're looking at steers or heifers. Other things that they can do to achieve this is utilize better genetics that excel in the performance category. Also animal health is critical to ensure those calves are healthy and grow at the rate that they should, and they aren't set back from any sickness. Here we have weaning length along with the average value for those calves. This, based on this data, it looks like you're kind of wasting your time if you're weaning for less than 28 days. You'll actually see there's a decrease in price from over the last couple of years from the calves that are shipped straight off the cow to those that are weaned for less than 28 days. And basically at 28 days, you're just getting the ball out of them, and you're honestly probably taking on more risk, as that's probably the time when you'll have the highest morbidity and mortality rate. So if you're going to wean, you might as well shoot for the 45 days. And if you do this, you need to market to the cattle buyers that this is what you did. They want to know your vaccination program. They want to know if these calves are bunk broke, and if they're adjusted to automatic waterers and things like that. So we added a couple new questions to the survey this year because we get asked about this stuff quite a bit. Your table on the left here is looking at your value added programs as well as your vaccination protocols. And anymore, when you're looking at your vaccination programs, you're not really receiving a premium for vaccinating. You're more like receiving a discount for not doing it. This data suggests that calves who receive 0 to just 1 round of shots before shipping are actually discounted $5 to $9 a hundredweight. You'll see the premium on the source and age verified, NHTC, natural, and GAP has a pretty big range from $3 to $17 a hundredweight. And because of this, I think it's critical that you do your research on the additional cost and the potential performance loss to make sure that premium is big enough to make up that difference. And then I wanted to dive in deeper and see what type of producers are doing the different vaccination protocols. And you'll notice that there's a pretty big jump in your high and average return producers for those that vaccinated at least twice before shipping, and you actually had a 10% decrease in the low return producers. But when it comes to your own operation, you need to evaluate that and make sure the benefits outweigh the cost. Some things to consider: do you have the time and labor to do it correctly? Do you have the proper facilities to minimize stress and eliminate any injury on the calves? This chart here is looking at what producers spend on bulls and the average value of the calves from those bulls. And you'll see here, this suggests that if you spend a little more money on the bulls, it will likely pay off in the end. Now, I don't mean you have to go out and buy the high seller this fall and next spring out of every sale, but if you're willing to spend a little more for that bull with a better genetic profile and one that lasts a little longer, it may be more beneficial. In this example here, if you were to spend an extra $2,000 and move from $4,000 up to $6,000, the survey shows that you would have made an additional almost $80 per calf. And you think about if that bull sires 25 calves, you've already have that additional expense covered in 1 year. And if you do, jump up to those superior genetics, you need to make sure that you market those genetics. Buyers want to know what to expect from a performance and from, potentially from the carcass value standpoint, and that will only enhance the value of your calves. Now, we started asking this question a couple years ago, and it's looking at to see how long producers expect females to stay in the herd. I think the results are pretty interesting, in my opinion. Based on the survey, producers expect a bred heifer to have 7 to 8 calves on average. Now, some may think this is a little optimistic, and if you think about it, this could be one reason why the female market has remained a little more inflated relative to the calf market after we went through those cycle highs back in 14 and 15. People think they can get an extra 1 or 2 calves out of that heifer. They're probably willing to raise their hand once or twice more at the auctions. This last chart here is looking at the producer's plan regarding expansion and liquidation. Over the last 3 years, you'll notice that the number of producers planning to expand in the current year, which this would be 19 in this case, is trended lower year over year. Now, it still remains at a pretty elevated level, but I think it's a pretty obvious steady decline as well. And there's also we've seen a slight uptick in the number of producers that plan to decrease their herd size. This data here just further supports that our expansion is slowing, and we're likely near the peak in the cow herd. So with that, I will turn the controls over to Dr. Mark Armfeldt. We greatly appreciate him taking the time out of his evening to join us, and I think the information he'll provide is very useful and very timely and coincides well with what we've shared. And we really appreciate Elanco joining us over the last several years to put on this webinar. We think there's some great value in it for our cow-calf producers. So with that, Dr. Mark Armfeldt, I think you should have the controls.
Thanks, Tanner, and I appreciate the folks at CattleFax for inviting me on to spend a little time with you tonight. We talked at the top we were going to visit a little bit about keeping cattle healthy and vaccination programs, and I've been asked to talk about one particular vaccine, which is our new Pleura. Before I go any further, is the screen up? Are you guys seeing that? Patrick and Tanner, who could respond?
Yes. Yep. We're good. Looks like you're good to go.
Oh, okay, great. Thank you. So a couple of slides just on bovine respiratory disease economics. It is the most costly disease affecting U.S. cattle. Combined costs include death loss, reduced performance. Tanner mentioned the keeping cattle healthy so they perform at the best, at their optimum, and calves that get respiratory disease that we treat do not perform as well as those that don't. And the other part of that equation is about 2/3, in a particular study that they looked at, about 2/3 of the animals did not get treated for respiratory disease. And they followed those animals to slaughter. And 67% of those that had no treatment for respiratory disease had lesions of pneumonia in their lungs. So those were calves that, in fact, did get sick. Their own immune system beat the problem that they had, beat that disease. So if we can boost their immune system through vaccinations and minimize the lesions in the lungs that those animals that get a respiratory infection but get over it on their own, that's going to maximize our performance. Those calves that had respiratory lesions gained 0.17 pounds less per day than the calves that didn't. We're also going to spend money on treatment, labor, and management. The annual losses for producers are approaching $3 billion. So obviously respiratory disease, bovine respiratory disease has a big impact on profitability. Mannheimia hemolytica, for some of you that are my age, you probably remember this as Pasteurella hemolytica. I think there's a group of people at universities that justify their existence by changing the names of these things sometimes. But anyway, it's the leading cause of the bovine respiratory disease complex. We can find it in about 3/4 of all the diagnosed cases. It's the most frequently isolated bacteria from pneumonic lungs that compounds the severity of other bovine respiratory disease complex. It lives naturally in the upper respiratory tract of animals. And when they're stressed or when a virus damages the immune capability of the respiratory tract, they move down into the lungs, and then they'll multiply and spread through the lungs, and they produce a toxin that actually damages that lung tissue and allows the disease to spread, or the bacteria to spread through the lungs faster. That's the leukotoxin that they produce. Kills the white blood cells in addition to damaging the tissue that would fight the infection, that would in essence come in and kill the bacteria. So I'm going to talk a little bit about new Pleura. It's our Mannheimia vaccine. And this is really a unique vaccine. It's the only one in its class that's a recombinant vaccine. And what that means is that we've taken the part of the gene that the leukotoxin is on, that toxin that the bacteria produce that kill the white blood cells that fight infection, and we've cut that part of the gene out that has the leukotoxin, and we've gotten rid of some of the other stuff that's on that gene which cause animals to be set back a little bit when they get vaccinated, some of the other endotoxins. And then we also, instead of killing that whole cell to make the vaccine, we take that leukotoxin gene and we take some outer protein membranes that would encourage the host animal that gets vaccinated to recognize that Mannheimia bacteria as foreign and attack it. We put them in an E. coli and they actually generate the toxoid for us. So it's really a high-tech method to make a vaccination. It's the same, that E. coli propagation of the vaccine is the same way we make human insulin. Some of the human vaccines are moving in that direction. Hepatitis B, the whooping cough vaccine, the new shingles vaccine. And that allows us to make a cleaner vaccine with less endotoxin than when we just kill that whole cell. And I don't believe there's any other Mannheimia product that does this. We do 12 trials on every batch of new Pleura to demonstrate efficacy. So there's 360 calves in the 12 trials that are under 3 months of age. We vaccinate them on day 1. Day 10, we challenge them with Mannheimia hemolytica. Day 14, we actually necropsy the calves and score the lung lesions. And that's how we demonstrate that each batch of product is effective. We've got control calves that don't get vaccinated, and then these calves that get the new Pleura. So you can feel really confident when you buy new Pleura that each batch is tested to make sure it's efficacious and it does what we say it does. We've kind of hit on this. I guess they're less reactive than other vaccines, and that's because it's a recombinant technology vaccine. As the outer membrane surface proteins, the purified antigen to the leukotoxin, and then that proprietary process that we clean that up, we get the toxins out of there. If you look at the endotoxin level in new Pleura compared to some of the other products that are out there, it's really quite a bit lower. Probably has the biggest impact on the lighter weight cattle in terms of how hard it is on them when you vaccinate them. We get protective immunity within 10 days after vaccination. This is the only Pasteurella or Mannheimia product that has that claim at 10 days. So it gives you quicker protection if you're going to, in times of elevated stress, when they're going to be moved, commingled. Tanner referred to some of the benefits of vaccination in terms of pricing the cattle, and this would be one that if you had given them the new Pleura, you'd want to make sure that the buyers knew that had happened too. I think that would help you in that whole what are they vaccinated for arena. And that's all I've got. Again, I appreciate the time to visit with you. I will give this back. Maybe. See if you got it. You get her back?
Yep, looks like I'm getting ready to take over. All right. Before we wrap things up, yeah, no, thank you for joining us. We appreciate it. Before we wrap things up, it looks like we did have one question. Patrick, did you get a chance to read over that?
Yeah, and the question is asking about what, if any, effects there could be on the cattle market from the cattle losses with the flooding through the central U.S. And up into the Corn Belt in particular. And I think that's a really good question, one that we've gotten a lot. And I'm sure you've all seen those, the terrible pictures floating around in the press and on Facebook and social media. Of cattle on islands, cattle stranded, and I think the cattle are still lined up 2 by 2 over there in some places. But there's been some estimates out there with losses as high as 1 million head, which we really think is pretty exaggerated. The way we run the numbers, we think on the upper end, it would potentially be 1 to 200,000 head loss, and most of those would be newborn calves. And so just thinking about that, we don't think that there should be a huge impact to the cattle market from that. It may offer a little bit of local price support in that area, or to feed yards that no longer have those cattle to buy from. But we don't expect that that's really going to change the market. If anything, I think assuming that those producers do decide to add back to their herds, it could extend this cattle cycle just a little bit longer. Assuming we do want to add those losses back. But we, by and large, we don't expect a big impact to the calf market from that flooding. Tanner?
All right. Thank you, Patrick. Yeah, I think you explained that very well. Just want to go over a few upcoming events that we have. We got our risk management seminar coming up in about a month, and I was told there's a few seats left if you want to register for that. We also have another one September 18th and 19th. That's a good way to kind of develop a risk management plan for your operation, or if you already have one in place, we can dive into it a little deeper and try to improve it. We also have our corporate college seminar coming up July 17th and 18th. This kind of gives you a broad overview of the industry, some of the different trends and different factors that impact the markets. Information on these seminars can be found on our website on the About tab. And then we'd appreciate it, or would like it if you guys would join us again for the Trends Plus Cow-Calf webinar on September 11th. With that, if you have any questions, send me or Patrick an email. Our emails are initial of our first name and then our last name at CattleFax.com. Once again, we greatly appreciate everyone taking time out of their busy schedule and their evenings and joining us for this webinar. And we hope you got some value out of this. We will be sending out the link for this webinar, the recording of this webinar, probably tomorrow or the next day if you want to review anything. We greatly appreciate Elanco supporting us in this webinar that we've done the last several years, and I look forward to keep doing it. So with that, hope everyone has a great evening, and thank you very much.